Good afternoon, everyone. Thanks for joining us today for this real estate trends presentation. We're going to go ahead and get started in just a few moments.
Good afternoon, everyone. Thank you for joining us today. This is another weekly webinar call that we're hosting, and today's topic is going to be on real estate trends. So, very important thing, and something that in the last recession that we went through back in 2007 to 2009, real estate was admittedly at the forefront of what drove us into that previous recession. And today we still get lots of conversation around what's happening with real estate, both in our local market as well as our national market. So today, the topic will be, as it says, about real estate trends, what we've seen in previous years, specifically what we saw at the end of 2019, where we went as we headed into 2020, and then what we are going to see as we move forward as well. So for those of you that are not familiar with myself, my name is Alex Barnes. I'm a wealth advisor with Cornerstone. If you're a client of mine or a guest, again, thank you for joining us today. Also joining us will be Andy Nock. Andy is an agent and a broker with Tate. He works in the Charlotte market. And Andy, why don't you go ahead and introduce yourself and give a little bit of a background for everybody on the call.
Thanks, Alex. Thanks for having me on today, guys. As Alex said, I am a broker with Tate Companies based in Charlotte. Live in Huntersville, work the Charlotte market up to Lake Norman. A little bit about my background. I came from the racing industry. So my background is in racing and engineering, and then transitioned into custom home building with my father-in-law. So I've taken what I've learned in those industries and applied it into residential real estate, whether it be numbers, trends, analyzing data to get the best outcome for my client. Some of the transactions that I've done, I just finished up my third year full-time in real estate, and mainly it's residential transactions. The primary residence, I do some investments, whether it's income producing or fix and flip type transactions. And I work hand in hand with commercial brokers. So commercial can be a little bit of a different world. And if you don't do it day in and day out, it's not exactly the best situation to put your clients in. So when I get those types of transactions, I refer those out to commercial brokers that I work hand in hand with.
Great. Thanks, Andy. Yeah, Andy's been a great resource. Friend of mine, known for a few years now. Always does well by clients. And so I asked him to join me today. So again, as a subject matter expert, somebody that can talk about the real estate market. So, at Cornerstone, we always talk about being kind of the quarterback of the financial plan. And Andy today is going to, hopefully share some good information as regards specifically to real estate, both trends and, for things to think about in the future. So let's talk about what we're going to, kind of the agenda or what we're going to go over today. So as I said, we're going to go over the current state of real estate. So speaking about 2019 as we approached 2020, prior to the COVID-19 pandemic, both, then now talking about the shock that COVID-19 has taken both to the markets, not just the financial markets, but now the real estate markets as well. What changes have happened due to COVID-19? So of course, we always, kind of our minds probably jump to the negative impacts, but as Andy and I will discuss later on, maybe there's a few positive things to think about as well that have kind of forced our hands or changes as we've gone through this. And then lastly, let's, kind of talk about the predictive nature of what we think the future of housing and real estate will look like. So talking about, changes to the housing landscape, what are considerations for real estate that somebody would need to think about in the future. So again, let's start here. So Andy, tell us a little bit about, 2019, how we finished, and then, kind of walk us through 2020, where we started the year, and then what the, impact from COVID-19 was, and what the projections were, and kind of where we go from here now.
Great. Well, let's start off with a little bit of context. So the average national appreciation rate for home values is right around 2.5% year over year. Keep that in mind as we talk through this topic. So in 2018 and 2019, we expected to see a little bit of a leveling off, a bit of a changing market. Since 2012, we've been on this really high, really fast positive trajectory and home price values. So like I said, 2018, 2019, we expect to see a little bit of a changing market, slow down, still be positive appreciation rates, but a little more into the national average range. We expected that to be, going into 2019, we expected rates between 3.5%, 5.5% over the next 4 to 5 years. We ended 2019 on the high side of that, about 5.5%, 6%. 2020 actually took off faster than what we expected. Lack of inventory, low interest rates really drove buyer demand. And the lack of inventory is really what has been driving those higher appreciation rates. Then the pandemic began. Obviously, that was a bit of a wrench thrown into the mix. Everything came to a complete halt. The trough was in April. We were down about 57% as far as transactions and volume go. We lost about 2 months of the spring market. As most people know, spring and summer is the busiest time for home buying and selling. So we lost 2 months of prime time. Currently, we're actually moving back up. We are in the early stages of a recovery. Pent-up buyer demand is starting to show through. As of today, our offices are actually up year over year with listings, sales, and closings. So as far as numbers go, the Charlotte area median sales price is actually up 7.5% year over year. Pretty high. Remember when we talked about the national average of being about 2.5%? The difference here is new listings. The inventory, people keep saying we're low on inventory. New listings are down 8.5% year over year, and inventory is down almost 47% year over year. That means our monthly supply or our absorption rate is right at 1.3 months in the Charlotte market. That's the lowest we've ever had on record. The supply is still down because the millennials are the largest group of home buyers and will continue to be. And also because the incredibly low interest rates. We've got interest rates that are right around 3%. I even had someone last week that was approved for 2.875, which is crazy to think about when you compare it to the 70s and 80s with the astronomical mortgage rates. So another thing that has really contributed to the lack of inventory, during the recession, a lot of home builders stopped building. They either went bankrupt, couldn't afford to keep moving forward. So we had a huge production loss, which has attributed to about 4.5 to 5 million houses that we are still lacking. And that has continued through because the builders can't keep up with the demand as it is, and still buyer demand is outpacing either new construction or seller sentiment.
Yeah, that's good information. I'm sure a lot of guests that are on this call right now, and clients, we've talked before about supply and demand, but if you could, why don't you kind of walk through for everybody here? You talk about inventory in terms of months, and you talk about absorption rates. Just real quick, why don't you run through what that is for everybody, and then talk through the supply and both the the buyer demand and then the supply issue. So of course you talked about through this trough we went through back into April. It sounds as though buyer demand obviously stayed high, but supply has continued to stay low. So why don't you dig into a little bit deeper on those two things for us?
Yeah, it's a great question. So as you said, a lot of times people talk about whether it's a buyer's market or seller's market or how much inventory we have. So when we say 1.3 months supply of inventory or 1.3 months absorption rate, that means if you stop putting houses on the market today it would take 1.3 months to absorb or sell all of those houses. So a balanced market is considered 6 months. So it takes 6 months to sell all of the houses that were currently on the market. Balanced meaning that the buyers don't have an advantage or sellers don't have an advantage. Anything below 6 months is considered a seller's market, obviously because demand is high, supply is low, therefore a seller has more of an advantage, prices go up. Sellers have a little bit more of their pick on who buys and what prices they can charge. Anything above 6 months is going to be a buyer's market. Higher inventory means it takes longer to absorb those houses. Buyers have more houses to choose from, therefore they can dictate pricing a little bit more, terms, timelines. So that's where we get that, buyer's market, seller's market. And like I said, when 6 months is considered balanced, and when you look at our current Charlotte market at 1.3 months, you can tell it is definitely a seller's market. And he asked about, buyer demand as far as seller sentiment. During the COVID recession, if you will, everything kind of dropped in tandem. So houses stopped coming on the market, buyers stopped buying houses on the market, everything kind of fell about the same rate. Now that we are coming back out of it, back into a housing recovery, buyer demand has definitely outpaced the seller sentiment, which means there are way more buyers coming into the market than sellers are willing to list their house, which is where we come into this, supply and demand, lack of inventory situation.
Yeah, great. Thank you. And so we did have actually one question just pop up that I do want to address. And I think this is something that, we plan to talk on anyways, but, I think it's a great question to go ahead and, address right now. So as we talk about the second half of 2020 and what we see going forward, one of our guests has asked, how are, people going to qualify for a mortgage with the recent unemployment? And then also, as we look into the back half of the year, from our side, from the financial planning side for clients or for those affected, maybe not necessarily some of our clients, but those who are receiving unemployment benefits to help pay their mortgages or pay their rent, what are we going to see from a foreclosure standpoint? What have we seen so far, right now? So you mind touching on that just real quick?
Yeah, definitely. As far as how people are going to be approved for mortgages, it's going to be a case-by-case or a lender-specific situation. I do know a lot of the banks have raised their minimum credit scores. Some of the FHA loans have become a little more stringent. And probably one of the biggest changes have been when they would call to do employment verification, which means the lender just calls your employer basically to just confirm that you do have a job. Typically, they would do that about a week out, a week and a half prior to closing. We've seen lenders actually call the day of closing to make sure that you are still employed, just because of the turbulence that we've seen. And as far as the foreclosure rates, yeah, that was something that we were going to talk on later. This is more of an equity situation than what we had in 07 and 08. Their homeowners now have far more equity than what they did back in 07 and 08. So for example, 37% of homeowners now own their house free and clear. 27% of those who have mortgages have more than 50% equity. So before, when we had the high foreclosure rates, homeowners were upside down or underwater in their house, meaning that they owed more than it was worth. Now, while they do have positive equity in it, say someone does come off the unemployment benefits, they can't make their payments, they're going to be able to sell their house and still make some money off of it because of the high price appreciation that we have and the lack of inventory. Where before, people were having to give houses away, there was a lot more inventory on the market. So while we will see some foreclosures, definitely, just because given our situation, the foreclosure rate's not going to be anywhere near what we saw in the last recession.
Yeah, that's great. And so, good point. Let's kind of transition here. Let's talk about how this compares to the Great Recession, as all of us went through back in 2007 to 2009. Of course, the housing bubble, the lending that was taking place that led to this. So we're in a very different situation. As you just talked about, where in the current market, we have higher equity within the homes that people are owning, even those that have already had their home paid off. So we'll dig a little bit deeper then for everybody on this call. Let's talk specifically, or let's talk some more specifics about, what compares as far as to the 2007, 2009 Great Recession and where we are today.
There's definitely been a topic that's been discussed many times. As soon as the COVID recession started, or as soon as COVID hit the United States, things started shutting down. Everyone started comparing it to the last recession that we had. So the difference is 07, 08, 09 was caused by the subprime mortgage market, which again, as we just said, put people in houses they couldn't afford. They were upside down, they were underwater. The COVID-19 pandemic is something completely unrelated to housing. Where the last recession was caused by the housing market, our current situation is caused by a virus. So the housing market has not been tied directly to the downturn. It's actually helping pull us out of our current downturn. The mortgage rates from before 07, 08, again, put people in houses they couldn't afford, tried to sell them, they couldn't, and that drove prices down. Inventory was high. In 08, they had 8 months supply. In 09, there was over 13 months supply of inventory. Right now, nationally, we're about 3 months. Only 7.8% of mortgages are in forbearance, and 24% of those are still actually making their payments. We've already touched on the equity, where before people had negative equity in their house, we still have positive equity. The other big difference is during the recession, housing prices were dropping, again, because of the high inventory rate. People were trying to undercut each other. Now we have positive appreciation rates. We're still seeing gains in house prices, and that's where we continue to forecast as a positive rate through 2020 and probably more of a gain into 2021. Touch on investors a little bit. In the recession, we had, again, a high foreclosure rate. Prices were cheap. Investors came in droves because it was a low entry point. We had a big drop in prices. Investors were able to get houses cheap. We saw a lot of investors buy houses and turn them into rentals. So that was a buy and hold long-term investment. Because we don't foresee a high foreclosure rate now, investors aren't getting in because of a low entry point. They're getting in because of a high appreciation rate expected moving forward. So before, investors were thinking, hey, let's buy a house, hold it, get the rental income off of it. Now what you're seeing, investors are buying houses or land and developing them into new houses because of the lack of inventory. They're trying to fill that void. Also, they're buying older houses, fixing them, flipping them, if you will, and selling them for a profit. So the sales cycle on the investment side is actually quicker now than what it was in 07, 08, even though the entry point is higher.
And that's good to know, because I know I have clients, and I'm sure other advisors, within the firm, and those who may be listening have, we're always looking for opportunities for our clients, whether it be, their primary residence, which again, there's an argument made there not to think of that as necessarily from an investment standpoint, but really thinking of secondary or investment properties specifically. Do you think that, again, going forward, as we talk about the second half of 2020, do we expect that there'll be more investment opportunities, or do you think that, as you just discussed and said, that really the appreciation, and that we kind of, with this low supply, maybe we'll kind of see that play out the same as you have been already, where the investor stepping into the market is specifically going to be for the appreciation, and maybe for some secondary income if you find the right property?
We see it as being more of what our current situation is, the higher appreciation rates. Houses are, based off of what we've seen from analysts, houses are as cheap as they're going to be moving forward. So if someone does want to get in, they don't expect to see any major drop in home prices. Again, this is as a whole. There will be pockets across the country that will have, you know, little areas that maybe will lose some value over this. But as a whole, investors are getting in and riding that appreciation out, or again, taking a house and updating it, upfitting it, and developing new properties to fill the void of the lack of inventory. That's on the residential side. Commercial, like I said before, is a different animal. We don't really know where that is going yet because we don't have enough people returning to work. So before, we saw a lot of shared workspace, flex desks, open working areas, where now it's transitioning back to the cube. So you're going to see cube farms and a lot of floors of these high-rise office buildings. So as far as investing goes there, like I said, it's not a clear picture yet where they're going, just because we don't have enough data yet.
Yeah, great. Well, thank you. So, and that's actually one thing as we touch into our later slides that we'll talk about kind of the future of real estate. But before getting there, let's talk about this pandemic, COVID-19 specifically, and what changes it's brought to your industry. So as we all sit here on this webinar today, most of us still working from home or having limited access to our offices. I know I can see you and others that can see me. We're both at home ourselves holding this. You know, so tell us about the COVID-19 pandemic and what it's done to the buying and selling process as it's forced the use of technology. What's actually changed? You know, walk us through that.
So there definitely are some silver linings, some positivity that have come out of COVID-19. One of which is the technological advances that we've had in many industries. Real estate is no different. First off is virtual showings. Obviously, we're on a Zoom call now, FaceTime, Google Hangouts, you know, video chat. I've done showings for people who have been overseas, out of the country, across the country, and those who just don't feel comfortable going out in public. So that's been one major change. Another one is ultra high quality pictures and video are now becoming the norm. And in-person showings obviously require some PPE. As far as the transaction process goes, a lot of it has become digital signature, coming through emails, doing everything online. And that actually speeds up the process, and it allows consumers to focus more on what they're looking for in a house rather than coordinating times to sign papers. The last part of the transaction, the closing, is still, depending on which state you're in. North Carolina, it still is required to have a wet signature done in front of a notary. They're actually working on getting that to be a remote notary or a digital signature as well. So that will actually complete the loop for a full digital transaction. Obviously, this limits the amount of contact you have. I said it speeds up the process, keeps you from having to touch pen, paper, meet face-to-face. What all of this has really done is just speed up the process of where we were heading. A lot of businesses are going more towards technology, whether it's virtual, whether it's remote workforce. And for example, our office planned to be paperless by 2021. We actually did that in about 3 weeks in April. So like I said, we were already headed that way. This has just sped up the process and got us there a little quicker. Like I said, the biggest part of this has just made it an easier transaction. We've just all adapted and still had to make transactions happen. We just found a different way to do it.
Yeah, and so I'm sure that there may be some people on this call or those who listen to it later that are wondering, like you said, the use of personal protective equipment, from a guideline standpoint. Describe or tell us a little bit more specifically about what's being required or what you're requiring, or if it's a governing body from a buying and selling, from a showing process if it is in person. And then also Touch a little bit more for those that are on this call that may be thinking about, again, the buying or selling process. What's been the feedback from clients so far on the virtual showings, on the digital closings? Does it seem fairly seamless? Have you had hiccups, or has it kind of been a smooth process so far?
Definitely a good question about in-person showing PPE. So CDC guidelines are what we try to follow. Each state is a little different. Each MLS area is a little different. But for us here in Charlotte, if you do in-person showing, all clients have to wear a mask. They have to wear gloves. They have to take off their shoes or wear shoe coverings inside the house. For me personally, when I have a client listing a house, I supply hand sanitizing wipes. We ask them to sanitize before and after they get in the house. Also, we'll leave lights on, we'll leave doors open just to minimize the amount of light switches, doorknobs, handles, anything like that potential customers have to touch. Also, we limit the number of actual clients that can be at a showing. So typically it's an agent and 1 or 2 clients instead of bringing the whole family. As far as how the transaction has changed, positive, negative, whether people like it, a lot of it has been very positive feedback. So it took a little bit of adjusting to get, used to right at the beginning. But for the most part, like I said, people are very, very happy with it. And what it does, again, it's because it speeds up the process by keeping individual clients from looking at, say, 15 houses. They'll have to go view 15 houses, narrow it down to 2 or 3, maybe see them a second time, and then potentially make an offer on one. What this has done is allowed them to see the houses virtually and narrow it down from those 15, say, down to 3, and they only walk in to physically visit 3 of them. So it keeps people from having to visit multiple houses, drive all over town, coordinate schedules. And like I said, most people have been very happy with everything so far.
That's good to hear. So I'm happy to hear that that's going well for you, your clients, and hopefully, others that are listening or that are involved in this process along the way. So, let's kind of go forward here then. So the future of housing and real estate, as everybody can read here and see, let's talk about considerations for the future. What are some of the changes and things that you think the COVID-19 pandemic will potentially reverse, or, what big changes could we see in the future as we talk about the, work from home, or the ability to work from home, as we maybe see higher density areas that are more affected by the COVID-19 pandemic, and what that could mean for the future?
Definitely a good question. Obviously, you don't have a crystal ball, but we do have analyst projections, some hypothesis on where we see housing going. All across the globe, we've had a trend towards high density development. So it's all mixed use development, parking underground, main level retail, upper level office space, and top level residence. You see that a lot in those high density cities such as Chicago, New York, LA. This is great for real estate costs. Your land costs are low. You can pack a lot into a small area. The downside is it's very high contact. Obviously, you have people who live there, who work there, who shop there, all coming in contact with each other. As soon as the pandemic hit, obviously, everyone immediately tried to get as far away from each other as they could. Can't do it when you're living in the 41st floor of a building and have to pass everyone on your way down. So when we saw this shift from everyone trying to get away from each other, going towards more rural areas, the suburbs, less dense development, especially when people are able to work remotely. So for example, Facebook said within the next 10 years, I think 50% of their workforce is going to be working remote. So you can live in Montana, fairly inexpensive, and still work in Silicon Valley. With that trend, obviously, people don't have to live within driving distance or walking distance of their office. You're going to see a push towards more of those more rural, more suburb developments. Housing construction, typically new construction, happens in those suburbs. year over year or month over month, we've seen a 55% increase in new housing construction starts. All of those are in the suburbs. So that also points towards that trend that people are moving a little further out from the city. This could also change the way that houses are built. Obviously, during the pandemic, we're all using, whether it's our dining room table, our kitchen counter, our couch as our office. Once people start working full-time from home or full-time remote, people are probably going to want a little bit more of a secluded office or a dedicated working space. So you're going to possibly see new homes with offices or older homes being converted to have an office. Also, if homeowners are living a little further away from those amenities that they initially moved for, spending more time at home cooking, you can see larger kitchens, more industrial kitchens, larger gathering spaces, living spaces, just because they're spending more time in their house and they are need a little bit more space there. Also, with children doing distance learning, homes are going to be more wired for internet, more technology. The whole house Wi-Fi system integrated is going to be more of a norm also. And yards, you know, a lot of time you'll see these high density urban developments where no one has a yard. If you're at home all the time and don't have to go to the city, a yard in general or a larger yard, you could start seeing houses having a little bit more of a footprint and a little bit larger property line. Again, there's no crystal ball, but this is kind of what we've started to see play out. And based off of our current working situations, we can see this moving forward. Like I said, commercial could be a little different. We've touched on the cubes. We've touched on, you know, more spaced out working areas. And even if everyone is, or I shouldn't say everyone, if people are also starting to work from home, we could see smaller offices in general. So possibly instead of renting out 50 floors, you might see an office only have 30. So again, office is in commercial, it's just a little bit of a different animal. Don't have quite enough data on that yet.
Yeah, and so, I mean, you just said it, but I was going to ask, I know you only have a small sample size so far, but, you know, people that are, let's say somebody's on this call who may be thinking about selling their home. Let's say if they're, you know, later on in their career, they're thinking about retiring, maybe downsizing. Do you think from the sample size you have right now, the consideration around the work from home, having a dedicated workspace, that's something that are buyers looking for that right now? And is that something that sellers should be considering as they go to market their home if they're looking to sell?
Yeah, what we've seen is buyers are looking for a dedicated office. And we've also seen a dedicated formal dining room kind of going away. So you'll see that in new construction, no dining room and a dedicated office space. As far as resale homes go, some of the older homes, people are starting to convert those dining rooms into a dedicated office. So closing it off, having glass doors, wiring internet into there, built-in desks, etc. So yes, office space is on the rise. Dedicated formal dining room is on the decline.
Great. Well, hopefully we won't be in this pandemic forever, and hopefully we won't, you know, all be working from home for the rest of our lives from this point forward. I know myself, I like to get out and be with clients and be with people. So just a quick recap, you know, I'll kind of touch on a few things and then hand it off to Andy so he can just do a brief recap of everything we talked about. But you know, the main things here that, you know, we went over today, 2019 was a great year. 2020 was the start of a good year. Like everything else in our lives right now, the COVID-19 pandemic has, as Andy said, put a wrench in almost everybody's plans. We're working from home. We're basically, you know, shut down the economy for a large part of the year so far. You know, as we kind of get out of this and we move forward, you know, the things to think about, both from a personal residence as well as from investment, if you ever get into that part of it, is to think about what changes you can make that are going to apply to, you know, how we work, live, and play from this point forward as we move potentially from higher density into the suburbs, as we kind of take on the ability to work from home. And as Andy says, we become more advanced in technology, not just within our workplaces, but in our home. So Andy, if there's anything that you want to touch on real quick or anything you want to leave us with, please go ahead.
Yeah, for sure. The biggest thing is letting everyone know that the residential real estate market as a whole is still doing really well. And reassure that our current pandemic has not stopped transactions. Believe me, it definitely did get scary in March and April because we thought everything was going to come to a halt for the foreseeable future, but we've adapted. We've still continued transactions, and we've actually excelled and have grown our transaction size and the efficiency that we do. This means things look a little different. Like I said, a lot more digital transactions, a lot more pictures, video, FaceTime calls. But in the long run, it's going to be better for everyone. Also, if, people have been kind of on the fence about selling, definitely it's worth considering if that is something that has been on your horizon, basically just because the real estate market as a whole is doing well.
That's great. And so I do want to answer one more question. We got one that popped up here as we were finishing up. So the question here is that for those of anybody on this call, for those of us who may be interested or thinking about it, looking into invest in residential rental properties. So more for the rental income than for the the price appreciation. Obviously, price appreciation would be kind of the icing on the cake here, but is the outlook strong for demand in the rental market? And obviously from a supply demand standpoint, that may be partly an issue, but are there still properties out there where looking to treat them as rental properties for the cash flow? Is that something that's still, again, out there and available right now?
It's definitely a possibility. It kind of depends on your market. So there are a couple ways to look at this. Rentals are going to be good for a period of time because with people transitioning where they live, working remotely, they might not buy a home right off the bat. They may rent in an area that they move to determine exactly where they want to live. The flip side of this is with the current mortgage rates, it is much easier for a buyer to buy than it has been in the past. So their buying power is much higher, much stronger, just because the cost of money, a mortgage interest rate, is lower than it has been. So there are definitely pros and cons to both sides of that. The other potential tough point could be your entry point of buying a rental property, just because prices are high. For someone to acquire a rental property and make any money off of it, it's going to have to be a pretty low entry point and a pretty high rental rate. But like I said, I definitely think there would be a market for some time, just while potential movers kind of figure out where exactly they want to be in their next home.
No, that's good. And like most things, even with from my side, there's, you want to be selective, and it sounds like the same applies here right now that, like at the market as it's run up in the last few weeks, in the last couple of months, that there's going to be industries that are still, reeling and having to deal with the pandemic and, stocks and asset prices that are going to be lower than others and those that have obviously risen faster. So it sounds like with real estate, that's the same, that there's definitely entry points, but it's about being selective right now.
Yes, definitely.
So let's see here. So one other thing to touch on, I have a question that if somebody had to sell and then buy, what would you recommend or what advice do you offer them?
That's definitely a good question. A lot of it comes down to determining timelines. If you have to be somewhere by a certain date, then we almost work backwards. And again, it's going to be situation specific. If someone doesn't have to sell to buy, then you're in a pretty good situation. You can buy a new property, then sell. If you do have to sell and then buy, getting those timelines lined up. We know houses are selling pretty quick. It's just getting prepared ahead of time. And then if timelines don't line up exactly, we have a few options, such as we have a lender who will actually allow you to buy and then sell your current home. So it allows you to be a little more flexible. And then in North Carolina, for example, we have seller possession or buyer possession either before or after closing. And a lot of times people, buyers, sellers, understand that the other party's timeline or situation might not be exactly what theirs is, and they'll work with you on either getting in a house before or after, or being a little more flexible on those specific closing dates and moving dates. But the biggest one is really just getting all of your timelines figured out ahead of time, and then almost working backwards on dates. So you know where you have to be, and then work backwards, and that'll tell you about when you should have your house listed. And based on typical turn rates, such as days on market, list to close, we can determine when you should start looking to buy another house.
Great information. Thank you, Andy. Well, thank you for everybody who joined us on the call today. If anybody has any questions or has any follow-up, please don't hesitate to reach out to myself, reach out to Cornerstone. If you want to speak with Andy specifically, this replay, this webinar will be up on our website, which is listed there on the screen at cwgadvisors.com. If you need to get in touch with Andy or a local real estate agent, please, now is a great time to talk with somebody. I think both Andy and I are ever the optimist, but that being said, I would like to hope that, everybody on the call today learned a little bit, whether it be investment products as it relates to real estate, or if it's just, what's going on with my primary residence right now. So thank you again for joining us this afternoon. And we hope that you'll join us for future calls as we continue to hold these. Thank you.